Buckle up. They are not stopping. The freight train has left the building.
I ain't gonna give in now. I just gotta live this now. I ain't gonna be man, I'ma kill this stuff real quick. I'ma go take it to town, cause I gotta be that king in the ring when I'm knocking them out when I'm back with the whip. I am just up on the journey. Just know that I'm just going insane.
Warriors, rise. Grand rising. Good evening, warriors all over the world. My name is Coach JV, and I'm here to make the complex simple for you guys. We're heading into the biggest shift in generational wealth, and this year from 2023 to 2024 is going to be the most critical time in our living history. Today, we're going to be breaking down and narrating Jerome Powell's video to the public around raising interest rates. As we narrate this, I'm going to break down just a little bit. Not a little bit. I'm going to break down the complexities from a 30,000-foot overview and how this is going to affect the American public and people worldwide. The first thing that we need to understand is that we are in a global situation. This is no longer just about America. Everybody, Americans, people in China, Russia, all over the world, the biggest countries in the world and the smallest countries in the world are all being affected. Canada, Australia, New Zealand, this is a worldwide thing. Since 2020, we've been a global pandemic. That has kind of phased out. Now we're going into a war narrative and then a climate change narrative. Our whole system is changing. Now remember, in the gold rush, the people that got wealthy was who? The people who ran to the hills to try to get the gold, or the people that sold the shovels in the infrastructure of the new system. Okay, so that's just a hint of where we're investing. So let's dive into this. So we're going to narrate this. I've been sharing with you guys. A lot of people have a ton of questions, which I'm so thankful for. If you want to get into the Warrior Academy in 2023, it's 7 days for free in 2023. You have 60% of people stay after the 7 days. That should tell you something. Now, if you're like me, you want to go a little bit deeper. What I've done is if you click on the link that says private coaching with Coach JV, we're almost full for the February. We have a class starting on Monday. Our class starting on Monday. We're launching another one on April 1st. So we're going to speed up the process a little bit. Every 2 months, we're going to launch a new class. Fill out the application down below. Even if you're not qualified for the private coaching, our team member will answer any questions you may have around the Warrior Academy. So we're here to support you. So click the link down below. We'd love to see you inside. All right, so let's take a deep dive into this video with Jerome Powell. So this was the Jerome Powell talking about the interest rate hike. And I've already told you guys that he said that he is going to do everything in his power to get us back down to 2% inflation. Okay, so let's listen to this. I'll narrate it, and then I'll break it down from a 30,000-foot overview.
Good afternoon and welcome. My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt.
That was key. The full effect of our rapid tightening has not been felt yet. Okay, that means a tidal wave is coming. Okay, they threw the rock in the pond. Starting mid last year, we started raising rates. They kept telling you job market is safe and still stable, but it takes a while to hit shore. The job market is about to be shaken and flipped upside down.
Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
Okay, so let's narrate that. So what he's saying is basically we're going to keep raising interest rates. So don't expect the interest rates going down. So what does that do? When interest rates go up and money is no longer cheap, we own multiple companies can no longer borrow their way out of problems. With high inflation and high interest rates at the same time, so cost of goods are expensive, interest rates are high, you don't have access to capital, You have to start laying off who? Team members. Every time you lay off a team member, we're a debt-based society. That is somebody not putting money into the system by borrowing, and that slows down salaries. So to bring it down to 2% inflation, they have to raise interest rates. And when you raise interest rates, the corporations have to start to lay people off.
In addition, we are continuing the process of significantly reducing the size of our balance sheet.
And that's what we showed you on the debt calculator. So they're printing less and the debt is going up. So debt is skyrocketing, they're printing less.
Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year.
So what they're saying now is gross domestic product last year, so the products, goods, and services that we produce, which measures the country's health, slowed down, so we're producing less, and consumers are starting to tighten because, number one, their interest rates are higher, their mortgages are higher, their rent is higher, eggs are $9, milk is $5. It literally is a tightening is happening now. Then there's a tightening, and then there's a tip, and then it's chaos.
Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated.
So they throw in these little positive things. Well, job market still, yeah, right now, he just said we haven't felt. So in the beginning, he said we haven't felt the reverberation effect of this yet, but job markets are good. So remember what he said in the beginning. We haven't felt the effects yet. I told you guys Q3 2023.
Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched.
Okay, so what they're saying is if we don't continue to raise rates and destroy the middle class and destroy companies, we will not be able to cool this inflation, and it will be entrenched in our monetary system. Remember, banks are in a liquidity crisis. Central banks are in a liquidity crisis.
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5 to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
Okay, so he just continues on reading off his paper, no longer looking at us anymore. It's getting deep. It's getting deep. So what does this mean? What does this mean? So let's break it down. Remember, I'm not an economist. I'm just somebody who studies macroeconomics, microeconomics. I have a banking, executive banking certificate. I understand banking. I understand business. I understand how to scale businesses. So I have the inner perspective in regards to understanding what is actually happening because I run companies. So we see the effect of that type of stuff. We saw the effect of money printing. We saw the effect of low interest rates and be able to borrow, to grow, to get capital, right? Well, when interest rates go up, okay, it strengthens the dollar. And what that does is actually crushes other countries. So our brothers and sisters all over the world, many of you watching this as well, as we raise interest rates, that strengthens the dollar, okay? And that weakens other countries because what they do is the investors, the wealthy people in the other countries, move their money out of those countries into the American dollar because all they're doing is trading money back and forth. So they bring it into the American dollar, okay, to get a better output or a better income, right? So they move it from, they move it from Canadian into American, right? And they hold it in American. Well, eventually, just like any market, what goes up must come down. So eventually they're going to pull profits, okay? So as we raise interest rates and we try to cool down inflation, eventually these people are going to start taking their money back to get their profits, and then the dollar is going to start to cool down. Then you're going to have a dollar that's cooling down. Your money's going to be worth less. Your interest rates are going to be high, and inflation is not going to be at 2%. And it's going to be so damn expensive to survive and live that the middle class is going to go down to the working poor, and the people making $150,000, $200,000 are going to go down to the middle class or the working poor section. People making $150,000 a year are living paycheck to paycheck now. So you have two choices. You can either sit back and watch the freight train come at you full speed, or you can start to understand how to invest in these volatile times. As Warren Buffett says, when people are fearful, which fear is coming, be greedy. And when people are greedy, you should be fearful. And let me explain what that means. When the markets come collapsing down, this is all a fake out. The crypto markets, the stock market, he raised interest rates, that strengthens the dollar. The markets respond favorably, blah, blah, blah. So these are all fake outs, okay? It's not a healthy economy. The stock market and the crypto market is based on emotion, okay? As an intelligent investor, you base your investments on intrinsic value investments. For example, when you're looking at something like XRP, XLM, QNT, HBAR, you want to look at the actual intrinsic value of that cryptocurrency and what real world solve does it have, okay? If you're looking at Coca-Cola and you're investing in Coca-Cola, okay, what is the intrinsic value of that? Are people going to stop drinking Coca-Cola? No. Are people going to stop using their Apple phones? No. Are people going to stop using Bank of America, one of the largest banks globally? No. That's why Bank of America, and when you look at these companies, Bank of America, Wells Fargo, Chase is going to be, these banks are global. You think they're local in America. They are global banks that are moving in distributed ledger technology, that are in cryptocurrency, that are using blockchain technology. Wells Fargo is using R3. So don't let your bankers and tellers bullshit you. They don't know. It's not their fault. They don't understand what's happening. The C-suite leadership isn't telling them what's going on. FedNow Services is going to be linking up with your local bank in March. Okay. So you have to understand intrinsic vesting, right? Stop this get rich quick bullshit, this Dogecoin, Shiba, all this stuff. You play with those things just like you play with those things just like you're going to the casino. You can get very wealthy off those types of things if you do it correctly, but that's not an investment strategy. That's gambling. That's having fun with your money. I have 10% of my portfolio that's weighted for that type of stuff. Okay. If it goes to zero, it doesn't matter. My point behind this is you need to start to prepare. You need to start cutting back on your expenses. You need to start cutting back on frivolous spending. If you have 2 cars, get rid of one, go down to 1. Free up cash flow. Get your debt paid off. Get your credit cards paid off. Free up cash and start to get an investment strategy going. Okay, because if you do this correctly within the next year, you could radically change your family's life. So number one is you need to stop listening to, don't even listen to me. You shouldn't be listening to YouTubers and TikTokers and all that stuff and getting your investment strategies. Number two is you need to understand how to become an intelligent investor. Read the book, Intelligent Investor. Number three is you need to understand Richest Man in Babylon. How do you grow money? Because it doesn't matter if you earn money, if you don't know how to grow the money, you'll always be an earner and you'll always be enslaved to money. And then number four, I would highly recommend you understand Rich Dad, Poor Dad. You need to get on the right side of the cash flow quadrant, okay? And there's so many opportunities, more than any time in history, where you can make passive income with all this amazing technology. You can take your knowledge, just like I do. I'm an educator, and I make a living being an educator. I've opened multiple companies now. I'm about to do another company. I'm an educator. I'm taking the things that I do, the products and services that I use, and helping other people. You can do the same thing, because the job market, Jerome Powell, who we just listened to, said he's worried about the middle class getting wiped out, leveraged towards technology, and coming back to a new economy. He said that in 2020. He said that in 2021. So it's time to prepare, warriors. So we'd love to have you in the Warrior Academy. Again, click the link down below. It's 7 days for free, or the description down below, from 2023. If you want to talk to a team member and ask questions or apply for my private coaching program, either way, you can apply for that. I'll have a team member reach out to you so you can ask any questions you may have. We want to make sure you have complete clarity. We are all about human connection. So I'm going to have somebody actually call you and answer any questions you may have and see if you're a good fit for private coaching or the Open Warrior Academy, which is super valuable. The key is who you're around in the next year is going to change everything. I love you guys. I appreciate you guys. We'll see you tomorrow. Warriors, rise, get your shit together. Let's go.